Today, you'll learn how to master dividend investing. Many dividend investors focus only on numbers like dividend yield, dividend growth, and payout ratio. These metrics are important, but they represent only part of the skill required for successful dividend investing. To master dividend investing, we must dig deeper to understand what lies beneath the dividends. Quick disclaimer, this is not financial advice. I'm not a licensed advisor, and investing carries risks. It all starts with profit. Before any company can pay a dividend, it must first earn genuine profits. A company that pays dividends using borrowed money or during periods of unprofitability puts its long-term health at risk. That is why a sustainable dividend always begins with a profitable core business. Once a company generates profits, management must decide how to use them. This is where the quality of management becomes critical. Management has three choices. 1. Strengthen the company's finances. 2. Reinvest in growth. And 3. Return cash to shareholders. Dividends should only come after the first two priorities have been responsibly fulfilled. Now, let's break down the three options. 1. Strengthen the company's finances. Just like individuals, companies must secure their finances before they start spending their profits. A strong dividend-paying company should first reduce high-interest debt. Any obligations costing more than 7%, including loans, bonds, or redeemable preferred shares, should be prioritized for repayment. It is equally important to maintain a healthy debt-to-asset ratio that fits the nature of its industry, allowing the company to survive downturns and giving it the financial flexibility to seize opportunities when they arise. Companies that prioritize balance sheet strength are far more likely to keep paying and raising dividends even during tough periods. 2. Reinvesting for growth. Good dividend companies don't just distribute cash. They continue growing. They reinvest profits into areas such as expanding operations, entering new markets, improving products, investing in R&D, or strengthening their competitive advantage. A useful benchmark is the S&P 500's long-term return of about 10% per year. If a company can reinvest its profits at returns above this level, reinvestment is usually the smartest use of capital. Dividend investors don't need complex spreadsheets to evaluate this. Look for companies with rising revenue, growing profits, and a strong pipeline of future growth. If these are consistently improving, reinvestment is working. 3. Returning cash to shareholders. Only after strengthening the balance sheet and funding future growth should management return remaining profits to shareholders. This can be done in two ways: share buybacks or dividends. Share buybacks reduce the number of outstanding shares, which increases earnings per share, supports long-term share price growth, and signals confidence from management. Share buybacks only make sense when the stock is undervalued. In some cases, share buybacks can be more tax efficient than dividends, depending on the country's tax rules. Finally, dividends come last, after all productive reinvestment opportunities and buyback considerations. Once dividends are paid, the choice of how to use those profits moves back to investors. Putting all of this together, dividend investing is not just about chasing yield. It's about owning businesses that generate real profits, allocate capital rationally, and build dividends sustainably over time. That's how dividend investing is truly mastered. If this video added value, subscribe to Invest with CY, where we don't trade stocks, we buy businesses.